Absolutely. Thanks a lot. So from small caps, let's now move on to talk about the macros of the market. Neelkanth Mishra, Chief Economist, Axis Bank and Head of Global Research at Axis Capital is our guest joining us now. Neelkanth, good morning and always great having you on the channel. Thanks for taking the time out. I want to start with the recent data point that we got on retail inflation, right? It surprised a lot of people negatively with this number coming in at that 7.44%, which is a 15-month high. What was your key reading? How do you think the RBI will move henceforth? And what is your own view on how, the interest rate scenario could pan out given the kind of data that we have?
So the only thing I found interesting in that inflation report was that the core inflation actually declined from 5.2 to 4.9. And that for a policymaker is far more important than where the price of tomatoes is. I mean, you must have seen those YouTube videos where you're starting from a seed, you can grow a tomato plant in 6 weeks. So already some of these prices are down. I think there are valid concerns around India's output of cereals, of rice and wheat, of why retail prices have jumped up. So there are some inflationary concerns given the really volatile monsoon. But as the MPC sets policy, while the mandate is on headline inflation, I think they will be anchored to what's happening to core inflation. And therefore, the necessity to raise rates further, I don't think is there. But if someone was expecting a rate cut in the near future, I think that was ill-advised anyway. I don't think till the time that inflation goes visibly below 4%, the MPC is going to be cutting rates. So we should see the MPC on hold for a sustained period.
So given that the RBI governor has reiterated his commitment to bring inflation down to below 4%, do you see a lot of non-monetary interventions going ahead?
Well, the RBI can only do monetary intervention, but I guess what you meant was interventions which are not linked to just interest rate changes. So yes, I think the tightening of the liquidity conditions so that the transmission of the rate hikes is much better or faster. And of course, the longer they hold on to higher interest rates, the more the impact on the economy. But on the rate side, I don't see any reason for them to move any further.
The Prime Minister has also stressed on fiscal responsibility and his opposition to freebies. So do you think that do you expect the government to stay the course as far as fiscal prudence is concerned?
One of the reasons why India's prospects have emerged or have become so prominent in the world today among investors, among corporates, and if you read the newspapers, even among the common people abroad, that it is because you can see 3-5 years without any fear of significant volatility. So it is reasonable to expect that the rupee will be, even if it has to depreciate or appreciate, it will be quite stable. Inflation trends, short of these disruptions because of weather, should remain reasonably stable. The interest rate environment, you're not seeing like 200, 300 basis point hikes or fearing such kind of hikes. And I think to a large extent, this is driven by the macroeconomic stability that seems to be the objective of the MPC and the government. And to disrupt that stability, meaning to start going down the path where you are sort of giving freebies to people, it will appear very attractive in the short term and may even boost growth. But then the aftermath of that sugar rush is a very bad hangover, right? So it means higher inflation, it means weakening current account, and therefore then the rupee needs to weaken. You just look at what's happening in the US, right? So because of fiscal indiscipline, now the 10-year bond yields are well above 4%, and the risk-free rate for I think global financial assets need to be marked up from the 2.5% that everyone was used to. So we need to be very cautious on how and why the government is spending. There's one quick point there that as you're trying to bring down your debt to GDP ratio, which is very elevated because the government had to bear a large part of the loss during the COVID shutdowns, you need to bring down the fiscal deficit, but if you bring down too fast, you end up slowing down GDP as well, and that hurts the debt to GDP ratio because the denominator slows down. Now, to do it prudently, what you need to do is spend on things that can affect GDP over a medium term, in the sense that you distribute that money to people, they will consume, there is a short-term impact. If you build a road or a railroad because of that, with that, the impact on the economy is over a 3 to 5 year period. And I think that prudence is one of the reasons why India is being seen as a stable growth economy over the next 3 to 5 years.
Neelkanth, hi, good morning. And good to have you, good to be speaking with you here. You know, the Prime Minister in the interview to Money Control has spoken about several aspects of G20, right? And of course, I mean, over the next couple of days, we will see a fair bit of coverage of G20 as we host it in Delhi. From an economic perspective, you know, what are the big advantages of doing it, of hosting it, in terms of new trade opportunities, you know, sort of ability to get in more foreign investment, showcasing ease of doing business? I mean, just your thoughts.
I think all of those points, and remember that in a meeting where you are the chairperson, you can set the agenda. Now there will still be spoilsports who will try to sort of slow the process down or make sure that the final announcements are not 100% to your liking. But you know, when you're looking at global geopolitics, these are moves that happen much faster than, or a much longer period than what our markets are used to, right? So these are things that are about a slow victory in a clause here, a phrase there, but there is a move forward, right? So India is showing leadership on, for example, if you see some of the changes coming through on the global regulation of crypto assets, on how I'm at least trying to build a consensus around the issue of climate financing. So these are long-term issues. I think to expect a G20 level resolution to start impacting the economy in the very near term is something I think would be unwise.
Would be unwise. Fair enough. Neelkanth, you know, the other thing, right, the Prime Minister spoke about shared global prosperity through optimum utilization of resources. What do you believe India is driving for here in terms of global economic cooperation? I mean, nowadays, I mean, the terms which are thrown around quite a bit are, you know, world moving away from a unipolar world to a multipolar world, trade tensions, etc., between the two big powers, US and China, are perhaps at an all-time high. Of course, I mean, even from a flow investment perspective, India kind of stands out. So just wanted your thoughts there, Neelkanth.
So equal sharing of resources means that on a per capita consumption of energy or per capita waste generation, there should be more equalization, right? So today, India's per capita consumption of energy is a fraction of that of the US, for example. And as India becomes more prosperous, and as you know, GDP growth and energy demand are very tightly correlated, we will be consuming a lot more energy. We'll need to consume a lot more energy, and we cannot do it the way the US did it. There needs to be more equality. You can't put burdens on India because India needs to grow now, and the US and the UK have already polluted their way over the last 200 years. So when these things are being discussed, that global resources need to be consumed more evenly, I think these are the most important aspects. There are now with say the growth in in the battery ecosystem, right? So there are critical components which are available only in a few locations, and there has been a gold rush. Basically, some countries have gone and have sort of started controlling those assets, and so as the demand for energy storage, the demand for batteries grows globally, will the sort of control on those specific reserves, will that slow down the rest of the world? Because those are not being shared equally. So I think there are many such issues that will emerge as we go forward.
Neelkanth, from a market standpoint, right, the next big event to watch out for is the elections. And in that context, in the run-up to the elections, what is your own expectation? Do you think that this time around there could be a lot of infrastructure spending? Because, we've seen a big run-up in many of these stocks, capex-related, infrastructure, the ancillary sectors as well. Your own thoughts on how to approach this in the run-up to the elections and what your expectations are?
So we've been very positive construction over the last 2 years, I would say, especially in the last 1.5 years. And this is not just because of the growth in central government spending on national highways and railways, but also the fact that state government capex had been delayed because of pandemic-related restrictions. They could not do work from home. They could not move files fast enough, and so both central and state governments are currently spending very aggressively, and I expect that this should continue for another at least 3 to 5 months. But then we may go into a period of a lull. But for other construction-related inputs like cement, we think that residential real estate construction has started moving up. Even independent home builders are now starting to show some action. So we have seen strong demand growth for tiles, for PVC pipes, for wood material, and this should sustain. So basically, some of the state and central government spending, I think, naturally will slow down as elections approach, because there will be a period of a lull, there will be a code of conduct, and the desire to finish projects, which are, or work on projects which actually could get executed or finished, after the elections would of course be not there. So there will be a bit of a slowdown, I think, but on the construction of commercial real estate, residential real estate, independent home builders, I think that activity will sustain.
So just to summarize, what does all of this mean from a market standpoint? Because it's been a fairly decent run up until now. I mean, the headline index, of course, has seen a single-digit growth, but in the mid-caps, there's almost a 25% return that you've got, since the start of the year. Given that we have elections, there could be more infrastructure spending. The RBI is largely looking to control inflation as well. Do you see many more positive triggers for this market to rally henceforth? And what would your prognosis be?
Actually, I'm quite concerned, and I heard some of the discussion you had with the previous panelists, and I would be tending to agree with the more cautious tone, which is, global cost of capital. Remember that our equity markets are not just about domestic flows. While domestic flows, I think, will keep the PE multiple supported, but remember that the global cost of capital, the global risk-free rates have already gone up by 1.5–2% points. So people were used to a 2–2.5%, maybe even a 3% 10-year bond yield in the US. Now we are in the 4–4.5% range. And as this happens, the valuation of all financial assets globally needs to adjust for this. If you remember 2010-11, when some of the consumer companies trading at 40–45 times earnings were considered very expensive. So over the past decade, as the US adopted a tight fiscal, loose monetary policy, the valuation adjustment, because the markets took a while to adjust to the fact that at every instance, monetary policy would be eased. The muscle memory of the market is still stuck there. And therefore, people are starting to talk about, but the P multiples can go higher from here. What is so wrong with 70 times earnings? And that environment, I think, has changed. So as we think about what is a reasonable multiple to pay for a stock, we should keep in mind the changed global macroeconomic environment.
Okay, all right. Well, Mr. Mishra, thanks so much for stopping by and giving us your view. We look forward to having a chat with you in the coming weeks as well.